let's talk about the state of the market. Here's some observations. Well, inflation, the CPI. Well, first of all, I think the CPI is a bunch of cooked, manipulated numbers, and I think it's in reality something like 3 times what they report, because they conveniently take things out of the CPI like housing and insurance. And, those costs are as horrible as they've ever been in, like, insurance, for example, my gosh, or property taxes and things like that. So the CPI is this made-up number that's supposed to be slightly accurate, so you can at least say C, but not so accurate that you become, that it were to cause unrest. So it just came in the other day at 2.5%. So what that means is stuff in the month or in the last 30 days was 2.5% more expensive than it was in the same month a year ago. The Fed's goal is 2%, as if any inflation is okay. We've been trained to believe that 2% inflation is good. No inflation is good, but we're not going to change that. There's just no change in that. Fed rate cuts, I think we're looking at 25 basis points here, and I think that meeting's next week. Possibly 50 basis points. I would say that we're looking at probably 2 to 4 cuts over the next 3 to 6 months. And depending on the numbers that follow, they could be much deeper, meaning bigger cuts. The whole idea behind raising rates is to make is to slow everything down. So, when you raise interest rates, you basically grind business borrowing, personal borrowing to a halt. And they've done a brilliant job of that. In other words, when they raise the rates to combat inflation, they wreck the economy intentionally. But wrecking the economy has been known to at least slow down inflation because demand goes off a cliff. Inflation is caused by demand. Well, when you crush demand, inflation slows down. The election impact I talked about, I said, look, here's the bottom line. At this point, I just want it over. I don't care what side of the aisle you're on, who you're going to vote for, where you're going to vote, whatever's going through your head. I don't care. You do you. Get this behind us, because then we can all just sort of, uncramp our muscles and get on with what it is we do. The markets would just as soon see there be gridlock in Washington. The markets are happier when there's gridlock because nothing happens, so nothing changes. And the markets prefer, you think people are resistant to change? Well, the markets are even more so. Recession. It depends who you ask. I say yes. Is this the soft landing? I don't think we've had a landing yet. We're like the SpaceX rocket. We're still out there. We don't know. But what I do know is everything that's going on is the moon's aligning to make for an amazing opportunity for us as real estate investors. It's still a supply and demand imbalance in entry-level housing, and that is a function of cost because you can't build houses cheap enough for entry-level buyers, so there's an affordability issue. But I will say that when interest rates come down, affordability goes up because entry-level buyers buy based on payment, and when interest rates go down, payments go down. They also qualify based on payment. And so what that'll do is it'll free up the markets and there'll be more transactions. It'll be more fluid and more liquid. And that's good for all. Something extraordinarily unique about this market is sellers have equity. And you might think, well, so what? So what? Here, let me tell you, so what? When sellers have equity, what that does is it makes it easier for us to do a deal with them. Is like grease on the gears of our transactions. Think about it. If a seller has owned a house for more than 3 to 5 years pre-COVID, the price has gone up a ton. They have a lot of equity unless they've refinanced it out, but rates have been high, so refinancing is not popular. And so instead of it like in 2010 and 2012, when its sellers owed more than their house was worth, what we have now is a case where motivated sellers owe less than their house is worth. So there's more motivation on their part to sell and try and recapture some of that equity, put it in their pockets. And that happened when we buy from them. Sure, it depends on the numbers. It depends, on the deal, but it is far more likely to happen. Sellers have equity, and they do today. I don't see that changing. There's some markets like, Austin's down some. Some of these markets that went like a rocket. Okay, they're a little bit soft and prices have softened up a little, but that's what happens. When the markets that are like a rocket are at the tip of the spear, they're also at the tip of the spear when it starts to come down. All real estate is local. And so if you're thinking globally, you're saying, well, the prices of houses are coming down. Well, I would say, where? Tell me where. Because all real estate is local, and there are some markets that are correcting some, but there's still so much demand and so much cash on the sidelines and so much equity. Now, one of the things that's kind of ground a lot of it to a halt is a thing called the lock-in effect, which is where, fascinating article about this last night, where you own a house that's too small or you're ready to move on. It's you've got your sights set on something newer, bigger, nicer, somewhere else, whatever. But the interest rate on your mortgage is 3% because you've been sitting on it for 7, 8, 10 years, whatever. And if you go buy another house, the interest rate's going to be 6.5. It'll probably be lower after next week, but not a ton. So you think, well, if I went and I bought twice as much house, if I went and I bought the same house for the same amount I sell this house for, my interest will double with no gain of any kind. So just the process of selling and rebuying will double my payment, or double the majority of my payment, before I pay another nickel for a better house. Lock-in. And you're going to start to see that free up, and you're going to start to see people move on. And what I think we're also going to see is a lot of houses with a lot of neglect or deferred maintenance because people have been locked in them for a long time and they haven't had the money or they haven't had the gumption to maintain it well. Some people are like, my car needs new tires, I need a new car. And they treat their houses the same way. So once this lock-in thing loosens up, we're going to find a whole lot of houses that need a whole lot of repairs with sellers who are very now eager to sell them and are in a major jam because realtors say, well, I can't help you unless you do $50,000 worth of repairs on this place. Well, the lock-in effect is a thing. The rules pertaining to wholesaling have changed in some states. There's a handful of states that now want you to have a real estate license in order to do assignments of contract. That is one way to wholesale a house. I'm going to show you 5. Fast, kind of. So if you came here thinking, well, I'm going to learn about wholesaling in this training, you are. And if you came here thinking, well, the way you wholesale houses is you flip the contract, you'd be partially right. There are several other ways. I think we crossed the threshold of many other ways to wholesale houses than just an assignment. So if you're doing business in a state that requires you to have a license in order to do an assignment, don't do an assignment. I mean, you can't wholesale the house, do it some other way, which we're going to talk about in a minute. And I will also tell you that South Carolina passed some crazy law that I still think it hasn't been on the books long enough. They're going to find unconstitutional, and they're going to repeal. If you're looking at wholesaling houses, I would suggest you think about utilizing One of the 5 strategies I'm going to share with you that really puts you outside of the purview of any of these rules. Okay, so we have some really interesting proprietary leading indicators in my business, and what I mean by that is with the business activity we do, I have the unique ability to sort of see what's on the horizon. So, most indicators, trading indicators, are trailing indicators. So they tell you what was, and an indicator that tells you what will be is really can never be 100% accurate, but it is very useful as a way of loosely predicting things. So we have some really interesting proprietary leading indicators. For example, our funding activity. Who are the sellers and who are the buyers? How many deals are we funding? Where are we funding them? How many dollars are we funding for our clients? How many dollars are they making? Are interesting signs of what's going on in the present and what's to come. Our skip trace activity. We see that as a leading indicator because as that starts to ramp up down, we know what investor activity looks like. Up. iBuyHouses.com leads. I own iBuyHouses.com. And the leads that come into that tell us a lot about the motivation level of sellers out in the marketplace. And that motivation level has been headed like hockey stick to the right up. General interest in our programs and our mentorship. Very, very interesting leading indicator as to what is going on. There are a lot of people who are coming to real estate or coming back to real estate. And what that tells me is the general interest in real estate investing is, up and to the right. Those are all good signs for us because if the market wasn't supportive of that interest, we wouldn't see the interest. Follow me? That's how these things are really leading indicators.